Hello friends, last week in my video, I told you that the smart money, the bulls had discounted the election results and unless the BJP lost elections in all three major states, the market would not show signs of easing. And look how the market has risen. I also warned you with the help of this intra-week range of the Nifty that very big moves were expected in the market in either direction. And it was validated. And how? Look at the big jumps that the Nifty made last week. Now, is this market basically likely to rise higher? And today's video is all about whether you should expect the bulls to continue to take the markets higher or there is likelihood on a small pause. The India story, of course, remains bullish as ever, but in the near term, are the Nifty and the Bank Nifty looking stretched? Let's find out. Now, banking and finance stocks bounce back. These stocks were beaten down in the last month and a half or more, but there was dual pressure triggered by short covering. Now, I promised you in my last week's video that I would record a separate podcast on what dual pressure is all about, how you can forecast whether a stock is going to hit an upper or a lower circuit. That video and that podcast is in the works. Now, let's go to the market roundup window. As you can see on the screen, the Bank Nifty led the way forward with the Nifty 50 bringing up the rear. It was, of course, like I said, short covering. The US dollar index bounced back and that resulted in profit taking in commodities, especially gold and silver. It was also escalated because of the US guidance by the US Federal Reserve that the US economy was doing slightly better than expected, and therefore a risk appetite for paper assets rose and bullion recorded some amount of profit sales. Oil and gas continued to fall, as I have been saying. Now, what is the outlook? I'm going to talk about it in my weekly strategy for my own personal trades. The USD INR, which is the dollar versus the rupee, rose a little, which means the rupee was marginally weaker. The 10-year benchmark bond yields eased by 5 basis points, which means bond prices actually rose a bit, and that also put wind in the sails of the Bank Nifty. The NSE gained a robust 3.42% in market capitalization, which means the rally was fairly broad-based. And thanks to Friday's buying and the rally, the US market ended in the green where all three indices are concerned. Friends, the market roundup done. I now come to our in-house indicators. Let's start with the MWPL or market-wide position limits. Now, these are limits utilized by traders as a percentage of the total allowed by SEBI. In the second week, in the second week of the month and the first full week after expiry of the November series, we are seeing a robust bounce in the MWPL at 36.67%, which quite simply is the biggest bounce in the post-expiry week in the last 20 weeks that we have covered. It spans over 4 monthly expiries, and immediately after the expiry week, we haven't seen this big quantum increase in the MWPL, which means the risk appetite remains robust. Are bulls buying? Yes, they are. So if this buying momentum continues, the market does have a possibility of going higher. I now come to the stock and index futures turnover. Now, these are three concurrent series, which is December, January and February. What you are seeing is a rather steep fall in stock futures turnover. Not really very surprising because the prior week in question was an expiry week and rollovers result in double turnover. The index futures turnover remained almost constant. That means in spite of the high base effect of expiry in the prior week, last week the turnover seems to have been maintained. Traders were trading fairly hectically. Now for the NSE advanced decline ratio, in spite of the fact that the Nifty recorded the largest single week gains over the last 20-week period covered by this chart at 3.46%. The advanced decline ratio, which is an average of all 5 trading sessions of the week, rose from 1.11 in the prior week to 1.14 in the last week. That very simply means that for every 100 losers, there were 114 gainers. So one Marshmallow trader's risk appetite was higher. The Marshmallow theory is explained in a separate video in the description as well as the pinned comment below. Friends, I now come to the prompt month futures basis. Now what is basis? It is a discount or premium enjoyed by the future as compared to spot. Now basis is the highest at the beginning of the derivative cycle and slowly eases as expiry approaches. But whenever risk appetite increases or short covering increases, the basis goes up and vice versa. What you are seeing is both the indices recorded marginal fall in basis. I told you last week itself that the Bank Nifty basis at 257 rupees was unlikely to sustain, and there you have it. It's dropped about 20 rupees in a week. The Nifty also from 107 basis has fallen to 105.5. Can this basis come down? I think it will, and if at all the basis comes down sharply, it could also be a warning that there is fresh short selling happening at higher levels, or maybe even bull unwinding. So do watch the basis on a day-to-day basis. I update this on our social media accounts every single day. Do connect with me there. Friends, I now come to our exclusive in-house indicator, the impetus, which you've been trusting for almost 2.5-3 years now. Now let's take a look at this curious chart. I have never seen an impetus of 1,200, 1,300 plus for the Bank Nifty ever since I started plotting it almost 3 years ago. Ditto for the Bank Nifty. I'm not seeing the impetus reach 450 plus levels. That very simply tells me that momentum was extremely strong. Remember dual pressure. Bulls are buying and bears are covering their shorts, which means they are also buying. Now that is dual pressure. How is it triggered? My podcast, which will come later, will tell you. Now this high impetus will obviously be difficult to sustain, which means some amount of profit taking or slowing down of momentum. If not an outright fall, a slowing down of the upward momentum might just be in order. Now this is also updated on my social media accounts every single day in the night. Do connect with me there, particularly our free Telegram channel, which hosts all our views, news and research material. Friends, I now come to a second exclusive in-house indicator, the LWTD, which you've trusted for over 2 years now. Now here, what you are seeing is the Nifty has gained 3.46% on a week-on-week basis, but the LWTD has fallen to the lowest reading in the 20-week period. What does it mean? It very simply means that at higher levels, fresh buying support might just be feeble. Can the market go up in spite of the fact that fresh buying support will be feeble? Yes, it can. That is, if short covering keeps cushioning the declines and bears are forced by rising prices to cover their shorts in panic. But do remember, short covering only cushions declines and pushes markets up in the near term. Once you've exhausted all the shorts, there's no more short covering coming in. It takes actual fresh buying to push indices or individual stocks into gaining perpetually after new highs have been hit. So ideally speaking, I would have wanted this LWTD indicator to also be above the zero mark and rise consistently. That's not happening. And on the daily chart, it will happen first. This is the weekly chart. Where do you get it? On my social media accounts late in the night every day. Do connect with me there. Friends, our in-house indicators done. I now come to the bond market. Now what you saw last week was a 5 basis point decline in the Indian benchmark bond yield because the RBI basically kept the repo rates constant, no change at all. And what we are seeing is the bank Nifty also gained because bond prices jumped. Now we are not yet out at 7.50, 7.60 where we start laddering sovereign yields all over again, nor are we below 7.10 or 7% where we start going in for gilt funds. So I'm kind of sitting on the fence and keeping the powder dry. Friends, the bond market's done. I now come to the bank Nifty, which led the bullish charge on the upside. It rose 5.46% on a weekly basis, and as you can see on the daily chart on your screen, it gained on 4 out of 5 trading sessions. The 46,370 level, once it was overcome, there was basically no looking back by the bulls. And what you're seeing is that the price is now very, very comfortably and significantly above its 1 month-long moving average, which itself has turned upwards. Now that tells you that the immediate near-term outlook is positive for now. Now since the bank Nifty has zoomed past all resistance levels and is in blue sky zones, it would be easy to assume that this is the non-stop bull market. But I want to draw your attention to a couple of things here. First of all, we are far away from the month-long moving average, so a pullback can occur any point in time. Therefore, one can basically say that mean reversion trading might just be a fair probability if that occurs. Next, let's take a look at the Fibonacci ruler that I have plotted from the previous significant swing high to the recent low made in October 2023. What you are seeing is that the 138.2% retracement extension is coming close to the 47,950 levels, which is approximately 700 rupees higher from where the bank Nifty has closed on Friday. Now the price has moved upwards with gaps, especially on Monday and Tuesday. We've seen very bullish gaps out here. So what we are seeing is that these gaps might just prove to be a small kind of chaotic attractors to the price and drag the price marginally lower. Let's now come to the weekly chart, which shows last week we saw a power candle on the bank Nifty. The price had already started inching above the 25-week moving average, which is a 6-month long holding on cost of an average bull, and it built upon those gains, and therefore the medium-term outlook has also turned positive. The other thing that you must note is that the price is now firmly entrenched within the bullish bank Nifty wedge formation, and after a throw under, which means a false fall or a fake fall below the wedge formation, it has now come back into the wedge. Now this false fall is called throw under. Now very high probability exists as per studies in technical analysis that a throw under is invariably followed by a throw over. So there is a likelihood that the wedge upper trend line may be tested or exceeded before a profit-taking decline occurs. So if a breakout occurs, don't just assume that this is an extension of a bull market. It could be a fake breakout because of a throw over, and then a fall might just come. I'm using the word might. Now, which means that the 138.2% at 47,950 that we saw in the daily chart on the previous screen possibly likely to be exceeded in a fake out, and then the market could fall slightly thereafter. Friends, in the week before last, this index was at number 1 on the most volatile counters list as per the statistical beta ranking that we maintain in-house. It slipped 1 notch to number 2. Now that's a minor relief, but a sectoral index like the bank Nifty being number 2 in the most volatile counters list tells you that the challenge level for a retail trader has by no means abated significantly. Now last week I expected an estimated range between 45,875 on the upside and 43,750 on the downside. It was exceeded by a big margin. Like I had warned you that prices could move exaggeratedly in either direction because of the election results, and so they did. The high was 47,304, much above my expected level. In the coming week, I expect a range between 48,425 on the upside and 46,100 on the downside. Here again, I think the prices might be exceeded in either direction because statistical beta or pure price volatility has not come down significantly. Now, high volatility means that you should be trading light, and you should also watch the daily, weekly and monthly pivot levels on the indices and commodities that we provide on our free Telegram channel. Do make use of them as an intraday or a swing trader, both as an options and futures trader. Friends, the Bank Nifty done. I now come to the Nifty 50, which gained 3.46%. And like the Bank Nifty itself, this index also rose on 4 out of 5 trading sessions, and that too with the gaps that you are seeing on the daily chart on your screen. Now, last week, I had marked the 20,222 level for a breakout, which was basically achieved effortlessly. On Monday itself, we opened with a huge gap up. Now, euphoria due to the elections has taken the prices higher. The price is far above its month-long moving average, which itself is rising higher. So the short-term outlook is positive. But do note that the price is far away from its moving average, which means a mean reversion trade could be in order. Now let's also do a Fibonacci analysis of the Nifty as we did for the Bank Nifty. Here I have taken two Fibonacci rulers, one for the bigger swing and one for an intermediate smaller swing. I've marked it in red as the first Fibonacci retracement, and that is red. The second one is a second Fibonacci retracement, that is in blue. The most wonderful thing that you will note is that both the longer period Fibonacci and the shorter period Fibonacci seem to be indicating that the 21,100 odd levels. Do remember that this is not laser precise, this is an approximation, and the 21,100 odd levels might just prove to be an area where bulls might come out and take some profits. This would be routine long unwinding, of course. Let's turn to the weekly chart on your screen, which shows the Nifty is in blue sky zone. Now, what is blue sky zone? Blue sky zone is basically in a new high. There is no overhead supply coming in from traders who had bought at previously high levels and are stuck when the market goes down, and therefore when their break-even point comes, they start booking profits and creating resistance at higher levels. So since that is not existing, the Nifty might just have relatively speaking smaller resistance on the upside. So the sum and substance is that the long-term bull market in India is very much and definitely in place, but in the short run, as Fibonacci analysis is indicating, there might be some amount of profit taking, which is routine, no harm. The weaker hands will exit and surrender their shares to the stronger hands, who will take the market higher thereafter over a period of time. This is a routine change of ownership in the market. In the week before last, the index was at number 5 on our most volatile counters list as per statistical beta rankings. It rose one notch to number 4. Now that's not good news. A broad-based index like that rising in volatility means that retail traders will find it a challenge, especially because it's been gapping up. So retail guys' challenge levels just went higher. Last week, I expected an estimated range between 20,650 on the upside and 19,875 on the downside. Just like the Bank Nifty, the markets exceeded my estimated resistance level by going to 21,006 on the Nifty spot, which means the upper target of mine has been exceeded by 356 rupees. In the coming week, I estimate a range between 21,375 on the upside and 20,550 on the downside. Please keep monitoring our daily, weekly and monthly pivots for both the indices and commodities to gain an upper hand where intraday and swing trading in options and futures is concerned. Friends, I now come to the last bit of statistical analysis wherein I gauge the retail risk appetite by way of their turnover contribution in each segment. The weekly chart on your screen shows that the index futures turnover fell marginally by 4 basis points. It is indicated as a blue line. The stock futures turnover fell sharply by 41 basis points, which is indicated as a red line. Do note that futures require a whole lot of margin and mark-to-market margins, etc., and therefore are higher capital intensive and also higher volatile. So traders were basically staying away from high volatility and high capital requirement. Now in the option space, the most liquid and capital-wise cheapest is the wrong word here, lowest amount of margin or mark-to-market margin or maybe even premiums are concerned. So index options saw a 88 basis point increase, which is indicated as a green line. Now this was the lowest risk instrument and traders were flocking to it out of risk contraction. Stock options, which are a little more volatile as compared to index options, saw a 43 basis point decline in turnover. It is indicated as a purple line. Overall, I would say that the risk fell last week. So why did the rally occur? Most of it was short covering. Do note how the markets have gone up with gaps. Short covering triggered by euphoria after the elections declaring BJP a winner, and surprisingly in all 3 major states. And that short covering was so hectic that it resulted in dual pressure. Like I promised you earlier, the podcast on dual pressure is in the works. I will be uploading it very soon. Now friends, for my strategy, what I would do in the market in the coming week, I will wait for higher levels in energy, that is crude oil and natural gas, and wait for appropriate prices to go short again. Yes, it's a fairly strong intermediate pullback. Putin has gone to Saudi Arabia and the United Arab Emirates, and therefore he's likely to announce some more steps to boost oil prices. There are elections in Russia next year and Russia does need higher oil prices. In the other segments, I will prefer to trim my trading exposure to equity due to the extremely high standard deviation readings. Now, this is a statistical metric that measures pure intraday price volatility for traders. Gold and silver have fallen very sharply because of better than expected US economic data. So appetite for high risk instruments like equity shares rose last week. But I will not write off bullion so easily because the long-term outlook still remains positive. I'm still sitting on dry powder, which is liquid cash where a fixed income allocation is concerned, because there has been little or no change in the interest rate scenario to indicate that rates have either peaked out and therefore I should be going into gilt funds right away. Friends, before I sign off from this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And in the comment segment, do let me know how my videos are helping you become a better trader. Also, share my video with your family and friends so as to help me to reach out to fellow smart traders like yourselves, and share them on your social media groups as well. I thank you for your patience in sticking around with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Have a very profitable week ahead. Bye-bye.